Well, a warm welcome everyone. Joel here from Solace Financial. Today I'm giving you a quick 5-minute walkthrough of what happened in the 2026 financial year and what we're watching closely as we head into 2027. It's been a big financial year, markets moved hard, geopolitics flared, and AI continued to reshape the global economy. Let's get to it. So the year that was, in 2026, it was a strong year for global equities, but not all markets shared the same momentum. The big winners were companies tied to the massive AI infrastructure build-out, especially in the US and parts of Asia. Australia lagged simply because we don't have many listed companies directly exposed to AI hardware and data center growth. Interest rates played a major role too. The US Federal Reserve cut rates through late 2025 and then paused. Meanwhile, the RBA moved in the opposite direction. 3 rate hikes in the first half of 2026 as inflation stayed sticky. But the biggest shock came in March, when the US-Israeli conflict with Iran escalated. The Strait of Hormuz closed and oil spiked above $100 a barrel. That triggered a global equity sell-off. But the good news, there was a ceasefire in April, and a memorandum of understanding in June helped markets rebound sharply. Let me give you the quick highlights on a month-by-month basis. In July, global equities surged. The US passed the One Big Beautiful Bill, boosting household tax cuts, but raising long-term deficit concerns. In August, Australian markets were volatile, value stocks outperformed, small caps rallied, and healthcare had a really rough month. In September, AI mania peaked. Huge partnerships, massive data center announcements, and a strong tech performance globally. In October, despite a US government shutdown, markets kept climbing. Gold broke through $4,000 an ounce. November and December markets cooled, but in Asia, especially Korea and Taiwan, they continued booming on semiconductor demand. In January and February, strong reporting seasons, rising commodity prices, and the RBA kicked off its hiking cycle. In March, there was a big sell-off, an oil shock, geopolitical tension, and rising bond yields. Across the full year, emerging markets and AI-exposed regions delivered standout returns, while Australia remained steady but unspectacular. By the 30th of June, the Australian 10-year yield sat at 4.77%, the highest in years. The Australian dollar weakened against the US dollar, finishing around 69.3 cents. The S&P 500 delivered a strong 22% annual return, but emerging markets were the real stars, up 44% over the year. Gold rose 22.9%, despite a sharp pullback during March during the liquidity event. Overall, the year was defined by AI, geopolitics, and interest rate volatility. Now let's talk about the outlook for the new financial year. We remain constructive but cautiously optimistic about global markets. Several themes continue to support growth. First of all, geopolitics. The ceasefire between the US, Israel, and Iran is fragile. Any escalation could cause short-term volatility, but historically these events don't derail long-term market performance. We've got structural themes. AI remains the dominant force. Companies are spending record amounts on infrastructure, chips, energy, and data center capacity. This investment is spreading across industries, lifting productivity and earnings. We're also seeing long-term growth in defense, reshoring of critical industries, and a massive investment in energy transition and infrastructure. Global growth remains below trend, but still positive. The US leads the developed markets, and Australia is slowing, but not quite heading towards a recession just yet. Inflation and interest rates, with central banks being cautious. Inflation is easing, but still above target. We believe the RBA is close to the end of its hiking cycle. The US Fed is more hawkish under the new chair, Kevin Walsh. Domestic credit remains attractive, higher yields in term deposits, and wider spreads in global credit. We maintain a bias towards Australian credit at the moment. Earnings growth should broaden beyond AI. Valuations are fair, but expectations are high, especially in semiconductors and defense. Australia holds a solid income market thanks to strong dividend yields. So that's a snapshot. It's been a strong but a volatile financial year, which is now behind us, and a cautious and optimistic outlook ahead. AI continues to reshape markets, geopolitics remain the wild card, and interest rates are nearing a turning point. If you'd like a personalised breakdown of how this affects your portfolio or retirement strategy, reach out. I'm always here to help you make confident, informed decisions. Thanks for watching, and I'll see you next month.